probably stared at a stock chart at some point and wondered, are you actually riding the bull, or are you just seconds away from getting violently thrown off? Well, most traders think they know exactly how to spot a rising market trend, but the far more profitable skill, the one that actually protects your hard-earned wealth, is knowing exactly when that market is about to aggressively reverse. Welcome to today's Explainer. We are going to decode the true anatomy of a bull market. The charts we use are basically a universal visual language of price action. By breaking them down together, we can start to read this psychological battlefield fluently. Because honestly, whether you're trading in New York, Mumbai, or Tokyo, the dynamics at play are exactly the same. We've got a fast-paced agenda today. First, defining the bull trend. Second, spotting a bullish reversal. Third, writing continuation patterns. And finally, number 4, identifying those crucial warning signs of a reversal. We are literally tracing the complete life cycle of a bull market.
All right, Section 1, defining the bull trend. Let's cover the market structure basics.
You know, it's actually incredibly simple to define a true bull trend. Forget all the noise. A true uptrend is nothing more than consecutive higher highs and higher lows. As long as the market keeps making a new high that is higher than the last one and a new low that is higher than the last one, the bull is alive and well. But the absolute moment a new high is created below the previous one, a lower high, that is your very first signal that the uptrend might be running out of gas. But it's super important to remember that these trends aren't just abstract lines drawn in space. They're living, breathing environments. They are driven by the sheer volume of participants, the frequency of their trades, and the available liquidity. Every single move up or down is a literal tug-of-war between buyers and sellers, and that is exactly what creates volatility. Moving right along to Section 2, spotting a bullish reversal. This is where we witness the birth of a bull market. To read this battlefield, we rely on candlesticks. We already know the thick bodies show the open and close prices, but it's the thin wicks that reveal the real drama. Think of a wick as a visual scar. It shows exactly how far prices were pushed by one side before the opposing side fiercely fought back and reclaimed ground. Picture a micro battle right at the absolute bottom of a downtrend. This is known as the bullish engulfing pattern. In this scenario, sellers make a small red push downwards. But immediately after, the buyers aggressively overpower them. They create this massive green candle that completely engulfs both the upper and lower ends of the previous red one. It opens lower, but surges to close higher. It is just a massive statement of power from the buyers that the trend is reversing right now. Now, consider an alternative reversal, brilliantly illustrated by the bullish harami. Imagine a huge, dominant red candle indicating massive downward selling pressure. But the very next period, we get a tiny green candle whose body is roughly 1/4 the size of the red one, sitting completely inside its range. This tells us that the intense selling pressure is suddenly drying up. The bears are totally exhausted, and the bulls are quietly establishing a foothold. Zooming out to a larger scale, we have the triple bottom reversal. You can literally track the sellers trying 3 separate times to push the price down through a lower support line. Bottom 1, bottom 2, bottom 3. But they fail every single time. The buyers hold the line. Once the price breaks above the upper neckline support with above average volume, it signals a massive breakout. The downtrend is dead, and a new uptrend has officially begun. Okay, Section 3, writing continuation patterns. Because sometimes a strong trend just needs to pause and catch its breath. Take the classic ascending triangle. Notice how the price highs keep hitting a flat resistance level, but the lows are getting higher and higher. The buyers are stepping in sooner and sooner each time. What you absolutely want to watch for here is the trading volume. The volume actually declines as the triangle forms, but brilliantly expands the exact moment the bullish breakout occurs. Then there's the symmetrical triangle. Both buyers and sellers are compressing the price action tighter and tighter. The highs get lower, the lows get higher. It's literally like coiling a spring. When it finally bursts above that converging downward trend line, again, backed by high volume, that is your clear signal that the current uptrend is continuing its march. And you can't talk about continuations without highlighting the bull pennant. This pattern always follows a steep, almost vertical upward move. We call that the flagpole. After that massive surge, the market forms a tiny symmetrical triangle, or pennant. This brief consolidation is essentially an open invitation for new buyers who missed the initial surge to jump in before the next massive leg up. Which brings us to our final and maybe most important part, Section 4, warning signs of reversal. the sudden death of a trend. Listen, to really understand market tops, you have to get this one fundamental psychological difference. Buying pressure is generally a slow, steady accumulation. It takes time to build an uptrend. But selling pressure, it hits much faster and infinitely harder. Why? Because in an uptrend, buyers are sitting on big profits. When panic hits, everyone rushes for the exit at the exact same time to secure those profits, which creates a sharp, violent fall. So what's the big takeaway? It's adopting what we call the seller's mindset. When an overbought market rallies huge and reaches a strong historical resistance level, you have to stop thinking like a buyer. You must anticipate the reversal and actively start looking for bearish signals. To actually survive this phase, retail traders have to hack the seller's mindset. That means following the massive volume moves of the big players, the institutions. These guys trade in massive quantities. When they start to distribute and sell at the top, volume spikes quickly. If you aren't paying close attention to these heavy volume shifts, your stop losses are going to get aggressively hunted and hit by the big players taking liquidity. So what does this defeat actually look like? It looks exactly like the shooting star candlestick. Found at the very peak of an uptrend, it has a tiny body and a massive upper wick. This is the ultimate visual defeat for buyers. They desperately tried to push the price up to a new high, but institutional sellers violently took control and smashed the price back down, leaving behind this long, tragic upper wick. When you see this, buyers are undeniably losing control. To wrap up our technical deep dive, let's consider the big picture equivalent, the triple top. Just like our triple bottom earlier, but completely reversed. You have 3 totally exhausted attempts by buyers to push to new highs. They fail each and every time. The volume dries up as the formation builds, but the very moment the price breaks down below that lower neckline support, volume surges. It's a devastating breakdown, and the bull market is officially over. Which leaves me with one final question for you. When you open your charts tomorrow, are you still just looking at random red and green shapes? Or can you finally see the battlefield? The scars of the wicks, the heavy footprints of the big players, the sheer exhaustion at the top of a trend. Understanding this visual language is exactly what separates the people riding the bull from the people getting thrown off. Thank you so much for joining me for this explainer. Keep studying those charts, and I'll catch you next time.